Hello, my name is Demetris Theophanides, and I'm a Senior Private Wealth Manager at XSpot Wealth. Welcome to the market analysis for the third quarter of 2023. Interest rates ended at the highest level in 2 decades in the third quarter. Although Federal Reserve decided on its last meeting to leave interest rates unchanged, it also left the door open to raising rates again before the end of the year. Fed officials do not expect rates to go much higher, but the general sentiment among investors is that interest rates will remain high for a longer period. The Federal Reserve has raised interest rates aggressively over the past 18 months, yet inflation remains above the 2% target, while consumption and the labor market remain particularly resilient for a long time. Oil prices are higher compared to previous periods, which contributes to higher inflation and supported the fears that inflation will remain at higher levels for some time. The market estimates that in the next period there will be a reduction in consumption. One of the main reasons for the reduction in consumption is the reduction of disposable income in combination with the high cost of borrowing. Since people have less money, they tend to spend less. This decrease in consumption leads to decreased corporate sales and corporate earnings, decreasing the value of individual stocks. This is already reflected in stocks of the consumer sector, which is experiencing significant losses. Given that 70% of the US economy is based on consumption, a slowdown in consumer spending will have tangible macroeconomic implications not only for US economy, but also for the prospects of global growth and could potentially result in a recession. On the positive side, the fall in consumption will lead to a faster fall in inflation, since inflation tends to decrease when demand for goods and services decreases. In an environment with high interest rates and lower disposable income, it is expensive for people to borrow money, and there is incentives for more savings. So, when people spend less on goods and services, inflation drops. Regarding corporate profitability, the third quarter of 2023 may hold many positive surprises. Companies have passed higher costs due to inflation on to customers. At the same time, the wage cost pressures did not significantly affect the profit margins for most industries. This is due to the resilience in consumer demand, which gave many companies the confidence to raise prices faster than costs. Since the second quarter was less negative than estimates, analysts expect a marginal rise in corporate profitability for the third quarter and for the quarters to follow. Seasonality had an impact in the markets for the past year, and if this trend continues, we predict a strong fourth quarter. October is known as a month with volatility, but not necessarily a negative month overall. November and December historically are very strong. In addition, statistically, pre-election years tend to be very positive for the markets, with September being a strongly negative month for markets, and the first days of October also being negative. The chance of a year-end rally is quite high. Anyone who follows the markets knows that some days market indices, stocks, and bond prices move up, and other days they move down. This is called volatility. The best advice is to invest and stay invested for the long term. The longer your investment time horizon, the lower will be the impact of the ever-changing short-term market expectations. We are here to help with a well-diversified and sound strategy, which will allow you to achieve your financial goals. Do not hesitate to request a free consultation. Thank you for watching this video about the market analysis of the third quarter of 2023. Please stay tuned for more videos to follow.